What if I told you that you could pay 0% taxes on some of your retirement income? It's true, and it has to do with capital gains. See, most retirees don't realize that long-term capital gains are taxed differently than ordinary income, and that opens up major tax savings opportunities if you know what to look out for. By managing when and how you take your gains, you can reduce your tax bill and keep more money in your pocket. But there are a few critical mistakes that you need to avoid along the way. Hi, I'm Rob Bacharach, financial planner and fiduciary with RB Wealth. Many people have heard that long-term capital gains might not be taxed the same way as ordinary income. But what we find is that most investors and even many advisors don't know how to properly leverage this tax planning opportunity to their own benefit. So today, let's take a few minutes to break down for you exactly how capital gains tax works and a real-life example of how you too could pay 0% taxes on your capital gains income. First, let's cover what the difference is between long-term capital gains and ordinary income, or what's other referred to as short-term capital gains. If we buy a stock on January 1st and we hold that stock until April 1st and then sell it, any gains that we have on the sale of that investment are going to be taxed to us at short-term capital gains tax rates, which are the same as ordinary income. Because we held the investment for less than 1 year, that's what causes it to be considered short-term, and that's what causes it to be taxed at ordinary income. Now, if we take that same stock that we bought on January 1st and we hold it for a full 1 year, now when we go to sell that stock, it's going to be eligible for long-term capital gains, which are taxed at different, more favorable tax rates than ordinary income. And this is the difference between realized short-term gains or realized long-term gains. It has everything to do with how long have we owned the investment for prior to us selling it and taking our gains. Now, some of you might be wondering from back in the fall what this whole unrealized capital gains thing was, if now we're talking about realized capital gains. Well, throughout the 2024 election, Kamala Harris was presenting the idea of paying taxes on unrealized capital gains. And so what this is this is the gains that you have on that stock that we're just talking about before you actually sell it and realize the gain. The unrealized gain is just what's there showing in your statement, or maybe the value of the real estate that you know that you have that's grown since you purchased the property. Those are the unrealized gains prior to actually selling it when you realize the gains. And today we are focusing on realized gains and how you could potentially pay a 0% tax on your realized long-term capital gains. So now that we've talked about the differences between short-term and long-term capital gains, let's go over the differences between the ordinary income tax brackets and the long-term capital gains tax brackets. You can see here on a chart we have a few different columns and two different boxes, one for individuals and one for married couples filing jointly. You can see that as we go down the chart, the income goes up. In the middle column, we have our ordinary income tax rates, and on the right column, we have our capital gains tax rates. And what you notice as you move down the chart as income rises is that the capital gains tax rates stay much lower than the ordinary income tax rates as income goes up. So 0% capital gains up to, for married couples filing jointly, $89,200 in 2024. They get to stay in a 0% capital gains tax bracket while they would be in a 10 or 12% ordinary income tax bracket. So you can see here from this example, this is why it is more favorable to have long-term capital gains and manage them properly than just taking ordinary income rates for all of our investments and income that we have. Now that you've seen the differences between what the ordinary income tax brackets are and where the capital gains tax brackets are, let's talk about how the IRS does what's called income stacking to determine if your capital gains would be taxed at the 0% tax rate or not. In 2024, the 0% capital gains tax bracket for a married couple filing jointly went up to $89,250. So the idea is being able to sell investments and stay below this $89,250 so that we can pay 0% taxes on a portion of our income. So let's show you how the IRS stacks it to determine if you qualify for this or not. The first thing that the IRS does is they total up all of your ordinary income. So if you have consulting income or you're still working, dividends and interest from money market accounts, this all counts as ordinary income. So they total up your ordinary income, then they add on Social Security, and then they add on distributions from IRAs, distributions from pre-tax retirement accounts. This is going to give us a total ordinary income number. Once we get this number, the IRS is going to subtract this year's standard deduction. So for a married couple filing jointly in 2024, that was $29,200. So they total up your ordinary income, subtract the standard deduction. Now we have our total taxable ordinary income number. What's important about this number is that the difference between this number and the $89,000 number that we have to work with for 0% capital gains is the room that we have before our capital gains would not be taxed at 0%. Now, I know this might sound confusing, so let's run through a real-life example of how the 0% capital gains tax bracket works, and so that you can review and apply this to your own situation. John and Mary are wondering if they're going to pay 0% capital gains on their long-term realized gains from 2024. Now, ideally, in a perfect world, they would have worked with their advisor during 2024 prior to making the sale to have that advisor help them determine ahead of time what sort of tax implications would take place from the sale of the stock that they're looking at. But in this instance, they are looking backwards. So we are now in 2025, and they're trying to determine what 2024's taxes are going to look like. Let's go through the income sources that John and Mary have. John and Mary have $15,000 of consulting income. They have another $20,000 in IRA withdrawals and another $5,000 in dividends. The rest of their income for 2024 needed to come from the sale of stock. That gives them a total of $40,000 of ordinary income. Doing planning around the taxes that are going to impact their total retirement income is really important. I'll also note that John and Mary have not yet started their Social Security. If they had, that would add a whole nother wrench into the tax planning involved with capital gains, and we'll talk about that in a separate video. Now, last year in 2024, the standard deduction was $29,200. So we're going to subtract the standard deduction from their ordinary income. This gives us $10,800. Now, they want to take $70,000 in capital gains from the sale of stock. We already know that the capital gains are going to be long-term because, like we talked about early on in the video, we know that they've owned the stock for over 1 year. So we know that the stock's going to qualify for more favorable tax treatment, long-term capital gains rates, but we don't know if it's going to qualify for that 0% income tax bracket or not. So we have $10,800 of taxable ordinary income. We're going to add on the $70,000 in gain from the sale of the stock to come up with a new total taxable income of $80,800. So our taxable ordinary income plus the long-term capital gains from selling the stock, we now have $80,800. Fortunately for John and Mary, because $80,800 is below The $89,250 0% capital gains tax bracket, all of that $70,000 of long-term capital gains that they realize from selling their stock are going to be taxed at 0%. And that's the power of doing the long-term capital gains tax planning. So instead of just taking additional IRA withdrawals to come up with that $70,000 or $80,000 of income that they need to live off in retirement, which IRA withdrawals would all be taxed at ordinary income, they took some of their income needs from IRA withdrawals, and then they took a large chunk of what they needed from realizing long-term capital gains. And this has a significant impact on what their total tax bill is at the end of the day. Now, you might be thinking, oh, as long as I stay below these income thresholds, then I'll pay 0% taxes. Now, that's not quite true. They're paying 0% taxes on the capital gains income, which was over 50% of the income that they used to live off of during this past year in retirement, which has a huge impact on their tax bill. But their ordinary income, they still have to pay ordinary income tax rates on. In addition to this, I mentioned that John and Mary had not yet started their Social Security income. So if you're watching this video and you have already started Social Security income and you're wondering how capital gains plays into impacting Social Security taxes, stay tuned and follow along for our video next week, where I'm going to dive deep into exactly how our Social Security income is taxed and how you can still leverage the 0% capital gains tax brackets, but what to look out for to avoid major tax implications on your Social Security income. Thanks so much for joining us today. I look forward to seeing you next time.